What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. Today, Stephen and I will be joined by Jake Oubina, economist at Piper Sandler and one of the most thoughtful voices out there when it comes to making sense of the data that's driving markets. I've had the privilege of working with Jake over the years, and I've appreciated his ability to cut through the noise and zero in on what really matters, especially now as we all try to read the signals from inflation, jobs, and the Fed. Jake, thanks so much for being here. Let's jump in. What data are you watching most closely right now, and how's it shaping your outlook?
Yeah, thanks for having me on, guys. And look, I mean, this year, 6 months in has felt like a bear from an information standpoint, and kind of how the cycle continues to evolve. It's felt like we've gotten an entire economic cycle in 6 months. And I don't think it's going to be any different as we move into the second half of the year. What we're hoping for is some evolution of that. And, I think we're seeing some signs that maybe some of that uncertainty that really ramped up, T-minus 3 months ago has been gradually coming down. This has obviously had implications for what inflation has looked like. I think largely vis-a-vis the consumer response to this uncertainty. It's had a further knock-on effect to a housing market that's already been sort of in the doldrums for a couple of years, and now looks like it's getting a little bit worse before it gets better. And then obviously the uncertainty for businesses, and I think that's showing through in labor decisions. And I think that data, which tends to lag the whole process here, is going to continue to look worse before it looks better. But our hope is, as we move into the second half of the year, we can start to transition away from what has been just a major headwind to economic growth, vis-a-vis uncertainty and tariffs, into something that looks like a pivot toward more pro-growth baselines here. And I think in large part, what that's going to come from is the positive business pro-tax depreciation provisions that are in the BBB. And look, if we can get capital investment to turn up here, which if you exclude AI and tech-sensitive sectors of the economy, we've been in an industrial recession for about 3.5 years. And so we get those to step up here again, in large part on the basis of just very positive depreciation from this bill. And you can get a pretty significant accelerant in growth as you exit this year. I have no problem, if CapEx steps up and participates in looking for an economy that's growing maybe 3% in 2026. But the key here, obviously, you have to start winding back and reversing a lot of the uncertainty and the damage that's been caused by that uncertainty, and continue, I think, to de-escalate on the tariff front if you want to really see the big payoff from, I think, what are pretty significant pro-growth trajectories here. But, we can dive into anything you guys want here. A lot to say on inflation, housing, obviously, labor markets, which, have evolved largely as we had expected from the uncertainty shock, and really anything and everything.
Great. Jake, I want to talk about what you just said in your outlook, which obviously sounds more positive and constructive, in relation to what you said after that regarding inflation. I think you mentioned interest rates and housing. So you've been using the term, you and your team have been using the term bifurcation. We've been using the term bifurcation. And one of the drivers of that bifurcation is the level of interest rates. How do you balance a more constructive economic outlook with what that could mean for interest rates, with so many parts of the economy starving for Fed rate cuts and lower long-term rates?
I think that lower rates has to be part of the prescription here. And look, the Fed's told us that they probably want to cut a couple of times this year. I think, after what's been pretty soft employment data over the last several weeks, I think we're probably accelerating that process in terms of what the market's pricing in. They want to get to something that looks like maybe the upper end of neutral by 2026, call it 3.5 on funds. The market's already closer to 3% in terms of the pricing and expectations. So that's part of the base case here, right? I mean, higher interest rates, the funny thing about the Fed tightening cycle is it did indeed create bifurcation. And we've definitely overused that word over the course of the last 2 years, but I think rightly so, right? So you had this dynamic where you look at the needle movers of the economy, right? You look at the top 5 to 10% of corporates or the top 5 to 10% of households, and they all underwrote their debt at record low levels in the wake of COVID. And the Fed then came to tighten, and it did nothing for this group, right? They didn't have to roll their debt the way they did historically. They were sitting on massive amounts of liquidity from all the stimulus that went into the system vis-a-vis the COVID stimmies, the multiple tranches there. And so as an example, you had the non-financial corporate space in the US, which had about $1.5 trillion in liquid assets going into COVID, T plus 2 years, it had about $3.5 trillion in liquid assets. We're talking money market funds and bank deposits, right? So hyper liquid stuff here. Because the stimulus money inevitably made its way to corporate coffers. People spent all the money, right? And so it ends up in earnings and revenues. And at the same time, the upper 10% of households, which tend to be net lenders, everyone else is a net borrower, kind of downstream from the top 10, also flush with liquid assets, right? And so the Fed then comes to hike, and non-financial corporates, and to the extent that you're more cash rich, you benefited more from this, turn this $3 trillion plus asset into a profit center. And so in a Fed tightening cycle, net interest expense in the non-financial corporate sector come down during what could be argued, the most aggressive Fed tightening cycle ever on a percentage point basis. And you had the same phenomenon in the household sector, right? Household net interest income rose $250 billion net. And a lot of that, most of it, accrued to the top 10%. So high rates, the Fed's rate structure has actually forced this bifurcation and made it wider, kind of institutionalizing the inequality that already existed, right, in this space.
Yeah.
And so I think now, if you want to narrow the bifurcation, I think you've got to cut, and you probably have to cut pretty aggressively. That's the thing that's going to get small businesses to get off the mat. I mean, you look at the non-financial corporate space outperformance to the non-corporate space, so big business versus mom and pop, and it's at a record outperformance. And you guys see it in your space, right? You see the outperformance of the S&P 500 relative to the Russell or the 600, and it's the same image, right? So I agree that, yes, lower rates have to be part of the prescription. Deregulation has to be part of the prescription. Deregulation hurts mid and small cap businesses the most. Large cap can diversify a lot of those costs. And if you look at the 4 years of the Biden administration, the regulatory red tape that was added to the economy was the equivalent of about 6.5% of GDP over a 10-year window. It made the post-GFC regulation, it dwarfed it, right? And so, regulation already costs in excess of 10% of GDP. You layered into that even more over the 4-year period of the last administration. Who does this hurt? Small and mid-sized businesses at a time where they're already struggling with high rates. So, Fed cutting, plus some deregulation, plus some positive CapEx provisions on the expensing side, all of these things can help you narrow that bifurcation and maybe finally see some outperformance, in the down cap areas of the economy.
So yeah, the solution seems easy: lower interest rates, help those that are struggling, and reduce interest income for savers. If this was 2019, this would be very simple. In fact, back then it was. The Fed cut several times in 2019. Now, the difference, of course, is that there's been an inflation shock. There's been an inflation re-education of businesses, policymakers, investors, analysts. So Jake, I know you've been doing this for about as long as I have. In fact, you and I, we're roughly the same age. We worked together back at Merrill Lynch 20 years ago or so. So how much more time are you spending on inflation, talking about it with clients, studying it, forecasting it, digging in, thinking about it, at least aside from when you're going shopping with your kids, perhaps? How much more time are you thinking about it compared to 2022? And how does that complicate the simple solution of just lowering rates to help those that are struggling?
So the short answer, and then I'll give you the long answer, is it doesn't complicate it, because I would argue inflation does come down very significantly. I would argue the path of least resistance for inflation is still lower. And I would argue that all the extrapolation from the inflation scare of COVID that's been done by a lot of market participants in terms of, inflation is structurally higher now, I think is wrong. And I think we can prove that. So, real quick, pre-COVID, right, we didn't really focus on inflation all that much outside of, is our gasoline prices up or down? And what is that telling us about the headline? Right? We basically take that and then assume 2/10 for the core, because it never really deviated from that.
CPI reports were just for the bond folks.
Yeah. Right. And to the extent that they missed by a lot, they mattered, right?
Yeah.
So you're right. Our focus on inflation has gone into hyperdrive over the last several years. And I think it's still taking up a large chunk of what I'm focused on a daily basis. But I want to touch on a couple of things. So one, we have to be cognizant that inflation, as we're measuring it right now, when we look at the CPI or the PCE, which is a derivative of the CPI and the PPI components, has a huge problem, which is that the OER, the owner's equivalent rent, And the rent components of CPI, which account for more than 40% of the core, account for about a third of the headline, lag what's actually happening in reality by about a year and a half, right? And this is partly because of the sampling methodology. So if I ask you what your rent is today, and I ask you 6 months later, it might not have changed because you're on a 1-year lease, right? And so there's a huge lag between what's happening in the marketplace for rents and how that's then being reflected in people's lease turnovers. And so you have something where, you look at the CPI OER and rent, and they're just about 4% year over year. They were mid to low 3 handles pre-COVID. But then you look at what's actually happening in the market for rents. And whether you look at Zillow or Apartment List, Apartment List has been in persistent deflation, right? Price cuts on rents for at least the last 18 months. If you swap out a real-time market index for rent, what's actually happening today in the economy, for the OER and rent and the CPI, we would already have headline inflation and core inflation at about 1%. And that's just math, right? The CPI ex shelter, which is a cleaner look at inflation because not a lot of people nobody feels OER. It's an imputed metric. And, people that have fixed rate mortgages don't feel any inflation from the rental equivalent, right? And so you take that out, you take shelter out, CPI ex shelter has averaged 1.5% since December of 2022 on a 6-month annualized basis. So I would argue strongly that inflation really hasn't been a problem when you look at it properly since then. And what happened to change the direction on inflation? So I have this slide in my deck, which goes through the 2 regimes that we had immediately post-COVID. So you had the 2020 to 22 regime where you had the federal government massively overspending. We spent about $4 trillion more than we were expected to spend. We were going to run $1 trillion deficits no matter what. Even if COVID didn't happen, we were still going to run $1 trillion deficits. But we spent $4 trillion more. The Fed underwrote that entire $4 trillion. They bought $4 trillion of treasuries versus the baseline. Okay, so we didn't ask the private sector for a cent in terms of financing that money drop. We gave it all in stimulus to the consumer. We had supply chain issues galore because you had production shutdowns around the world. No one was on the same schedule because the COVID waves were all different and happening at different times, et cetera. And so you look at something like a supply chain pressure index, and it was off the charts, 4 standard deviations from normal or something like that. What did CPI ex shelter do in this period, this 2020 to call it late 22 period? It accelerated. You had some modest deflation immediately when COVID started because the world shut down. And then you were ripped to 12.5% on a 6-month annualized basis, right? And as soon as you reversed all of these factors, so the government is still spending a lot of money, but their trajectory, their rate of change of spending has leveled off to something that looks closer to pre-COVID. The Fed has been de facto demonetizing because the portfolio has been running off with QT. And so treasury holdings have come down. So it's a de facto demonetization. And you've fixed the supply chain issues. In fact, you've got too much supply in many pockets when you look at logistics, trucking, containers, et cetera. So you've gone the other way there. And since that period, once you entered into the second regime, CPI ex shelter inflation has averaged 1.5%. It has not been an issue, right? So I push back very strongly against this idea that we have a structurally higher inflation profile. I would argue that it was all COVID. It was textbook deficit monetization, the big money drop. Consumers spent it. No one cared about what they were paying. Companies took price with reckless abandon, right? And now we're in a very different world. Now we're in a world where if you properly measure it, I would argue that you're significantly below the Fed target. I would argue that the things that have transpired over the last 3 months vis-a-vis tariffs have dampened it even more. So we've seen some near-term pressure on goods, right? Because that's the clearest pass-through from here. So you've seen e-commerce pricing inflation. It's not positive, it's still in deflation, but the trajectory started to move up a little bit. And you saw CPI goods inflation over the last couple of months come in stronger than it has. But you're seeing the opposite in services, right? The super core, which the Fed loves looking at, is easily annualizing below 2% over the last 3 months because things like airfares, hyper discretionary type services spending has suffered as you've had some more inflation on the good side. The consumer is budget constrained, right? And this has been our point about tariffs the whole way. Tariffs like a tax, and the consumer is budget constrained. If you take up the price of an import, the consumer has to make a decision. Do I still want to buy that? And thus I'm buying less of everything else. Or do I want to just buy less of that? In both cases, you're reducing real demand, right? And this is how a tax works. It's not the consumer of the 2020, 2022 stimmy drop. It's a consumer that's budget constrained. It's a consumer that has seen delinquencies go up meaningfully over the last 12 months. It's a consumer that's increasingly worried about the labor market, right? And you're seeing it in the numbers. And it's a consumer that, if you look at the dynamics of spending, income, and savings, is telling you they're worried and they're actually holding back. So I'll give you a couple of data points on this, right? Wages and salaries in the United States through May, 5.5% annualized over the 3 months through May. That's a really good number, right? That's as good as it gets. And yet consumption is down to 3%, right? Why? Consumers are saving more. Consumers are saving more. Precautionary savings is up because of all the uncertainty you've layered into the economy. Now the worry is, okay, if the uncertainty continues to drive the job market lower, the job losses start to pick up. And we've seen a couple of numbers recently where you've actually had outright declines in employment growth. Then does the income number start suffering? And then we have to have a different conversation about the second half of the year. I think for now, it's the uncertainty shock, people responding to that vis-a-vis more savings, and that's throttling down the economy in the second quarter vis-a-vis consumer spending. You can unwind that very quickly, get the bill passed, no tax hike at the end of the year, positive provisions for business, de-escalation on tariffs, et cetera. But I would argue that what's happened over the last several months here, the last 3 months in particular, this drive to precautionary savings really runs against the theme of, tariffs are going to be, super inflationary here. I think it's incredibly hard to take price right now as a business. And I think to the extent that you try to do it and it shows up in the CPI numbers as, sticker prices are going up, I think it will be incredibly temporary. There's only, and I'll stop here, but there's only two ways you can offset the tariff increase. One is with more stimulus, which kind of makes the tariff sort of irrelevant. You're trying to raise revenue with it. And two is leverage, right? Consumers going to lever up and that creates money in the economy, bank lending. Neither one of those two things is happening in an era of, one, you're trying to raise revenue with tariffs, and two, you're still dealing with uncertainties related to the first thing. And so you're not going to have this massive credit cycle in the consumer. So we're very confident that to the extent that tariffs are in place, to the extent that they are significant, and to that degree, you will see the opposite effect on growth. Higher tariffs, lower growth, inflation comes out in the wash here.
All right. So a lot to unpack there. I agree with you on, of course, on a lot of what you said about inflation. I think the tricky thing to appreciate in this backdrop, and we see it in markets, especially in the treasury market, looking at, interest rates and how volatile they've been, yet how they've gone really nowhere in the last couple of years, looking at the 10-year yield. There's been a lot of back and forth on where rates are going due to where inflation is headed. So, there's been a behavioral shift in the thinking about inflation. Clearly we're seeing Powell, probably kind of drag his feet to cut rates, obviously because of tariffs, but I got to think there's some scar tissue there from the COVID, that he was clearly late to raise rates in COVID. So he doesn't want to be early to cut rates with, I guess, him viewing the risk. Ironically, the risk is of inflation could be to the upside, not the opposite pre-COVID backdrop where the risk to inflation was kind of consistently to the downside. So you said something that's important about the consumer savings, especially in the last few months with respect to companies' pricing power ability. This is my anecdotal gut, but to me, it feels like, 2022 just changed things so dramatically. Right? We go through history and, human evolution, and, you get these shocks that really change behavior. And then people kind of realize, I was doing this. Why did you do it? Because everyone did it. And that was the way to do things. And really pre-COVID, you didn't see too much greed in terms of trying to take price. And post-COVID, I feel like you have. And if anything, it's become so commonplace and acceptable to the consumer, or expected, maybe not acceptable, but expected, that price levels are high. And if they go up a little bit, it's because, their labor costs are going up or something. That, to me, it feels like companies are going to, if at any time possible, look to take price, whether it's directly a result of tariffs and passing it on, which is obviously something a company wants to do so they don't take a margin hit, or they see other companies taking price and they're just like, well, I might as well too, because again, consumers are kind of just used to it.
Yeah.
So how do you think about that? And in kind of longer term, as impacting the dynamic of around inflation going forward? Was that going to stick, you think? It's hard to see us going back to the pre-COVID world after this shock in behavior.
So I would argue that it's more likely that we do go back to the pre-COVID world. And I would argue that because of what transpired during COVID and because of how people have anchored themselves to price levels, not the rate of change, and I'll explain in a second, I think it's going to be incredibly hard for any attempt to take price, which there will be attempts, no question. I mean, you're probably going to see toy prices, if the China tariffs stick, you probably have to raise them 25 to 30%. But I think you will get immediate demand destruction. We ran this experiment in 18 and 19, it was appliances back then. I mean, we increased tariffs as temporary, 25%. Businesses went out there and companies went out there and increased their prices 25%. And you saw immediate demand destruction. And 6 months later, they were cutting, right?
Yeah.
There's a competitive reality to all of this, right? Yeah. And so one, I think companies, given the competitive reality, will be careful with any attempt to take price. So we've got, you look at the non-financial corporate space going into the tariff event here, and profit margins are at record highs, and no matter how you measure them. I like to look at them as a percent of nominal GDP, because it just tells you how much more of the nominal economy has accrued to profits. And we're at 8% in the first quarter of this year. We went into COVID at 5% of nominal GDP. Okay, that's a huge buffer. Compensation.
How much of that is just NVIDIA selling
a
chips,
lot.
right?
Yeah, a lot of is the Mag 7 for sure.
Sure.
But you can go across sectors and it's high in the vast majority of them.
Agree.
Even on kind of a NIPA, kind of economy-wide basis here, right? The other thing I'll say is the pressure from labor, which again, I think we went through this thing where in COVID, the labor shortages, and there was this extrapolation, wage pressures, labor power, and that's going to lead to more inflation. The only reason people got paid more was because corporate revenue was very strong. Companies never gave up margin to labor during COVID, except for a very brief period in early COVID. Yeah. The compensation expense relative to revenue, and I'm looking at NIPA here, like the overall economic, corporate, non-financial corporate space. Pre-COVID, you were looking at about a 59% comp to revenue percentage. We're currently at 56, just below 57, which is a record low, right? So for all the talk about labor power and wage price inflation feed through and all that, that just never transpired. So companies are going into this with record margins, record high liquidity. And yes, there's bifurcation within there too, right? Obviously. And a record low payout to comp. And so they have the mechanism to take a little bit of margin pressure if they want to stay competitive. They also have a mechanism where the bigger you are, the more leverage you have with your suppliers. So I think the exporters exporting to the U.S. will also have to take some haircut here as part of the, and to the extent tariffs are sustained. Consumers, you look at behavior, right? They're really upset about price levels. They don't care that the rate of change of CPI X shelters down to 1.5 and back to where it was pre-COVID. They care that they're paying 30 to 50% more than they were pre-COVID, and they've anchored themselves to that. So you look at something like, and I know the University of Michigan survey had a lot of problems from a political polarization standpoint when it comes to confidence and things like that. But one thing it's been very consistent on is this question of, is your financial situation worse compared to a year ago because of price levels? And that has not come down from basically the COVID highs. And it's still at levels that were around in the late 70s, right? So I agree with you that there's been some permanency in terms of the psychology, but I think that what's happened with the psychology is this anchoring to unrealistic price levels, I will say, because if we got a 30% decline in prices, that would be a massive deflation and depressing environment for growth. But there's this anchoring that I actually argue leads to business having a much harder time trying to take price now, because people have anchored themselves to these ridiculously low price levels. And then you look at the dynamics of inflation, and this is another point where it gets to the psychology and how people are feeling about price. And when you break down inflation, to the extent there's any stickiness, it's been in the non-discretionary parts of inflation. It's been insurance, which is catching up to all the asset inflation that you saw over the course of post-COVID, right? Cars, houses, et cetera. It's been, things like veterinary services, other healthcare, things that basically consumers don't want to diversify away from or can't, right? And we built this huge basket. Outside of that, the discretionary stuff imploded. once the money drop, the money drop experiment went away. And so non-discretionary inflation is also crowding out discretionary pricing power, making it even harder to try to pass on costs.
There's a question I have. I don't want you to get too far away from this point, or I don't want to forget to ask you. And it was about these baskets you created regarding inflation, these discretionary goods baskets and non-discretionary, and you showed there was a huge dispersion between them. And another way to think about it, or another way to think about inflation, and especially in this bifurcated backdrop, I would imagine that, again, for lower income consumers with less savings or negative savings that are interest rate sensitive, et cetera, they're going to feel, of course, the impact of inflation more so than someone with abundant savings. How do you look at, or have you looked at, splicing CPI in kind of what are the goods and services that lower income folks tend to spend money on, and where's inflation there versus a higher end goods and services or consumer basket? In other words, putting aside the fact that any increase in price is going to certainly hurt the lower income consumer more, at the end of the day, are higher end consumers facing more inflation today? And is that usually higher? Is there anything unusual going on at this point?
So typically, it's a great question. Typically, and I have done work on this. So typically, they're pretty aligned, right? And, post-COVID, you definitely saw a break. And so if you look at inflation, and I think you have to look at it, ex shelter here, because, when you look at upper income, let's say, again, your house spit off, it's irrelevant. If you have a fixed rate mortgage, it's irrelevant. And so you look at ex housing inflation, and I haven't run the numbers on this recently, but let's say as of 3 months ago, there was almost a full percentage point gap between the inflation rate of the lowest income quintile and the highest, with the lowest being 1 full percentage point higher, right? Their sensitivity to a lot of the things that saw inflationary pressure, goods in particular, their sensitivity to food, energy, right? And I'm not stripping those out of here because those are very real, just leads to this much wider inflation rate for that group. Now, it's been narrowing, but I think it's been a problem. And, you layer into that delinquency rates, so to the extent that you are poor or younger, your delinquency rate's higher, right?
Yeah.
Job losses, labor markets that are sensitive to lower wage sectors have basically been flat for the last couple of years in terms of net job gains. And so there's been incredible pressure there. But I think you have to also be mindful that in terms of what drives the consumer and ultimately demand, and then insofar as you want to make any extrapolation from that to inflation, it's really about the top 10%. Right. And that's been really all the growth over the course of the last couple of years. Even companies like Walmart have highlighted that, outside of the upper income cohort, they've basically seen no growth. And that's because, you look at the breakouts, and the top 10% controls about 45% of all labor income, right? The top 10%, even more strikingly, controls about 3/4 of all wealth. So you think about the wealth effect, whether it's real estate, where, maybe we're going to see some softness there, but up until now, home prices are up 40 to 50% versus where they were pre-COVID.
You got some room.
Yeah, you got a lot of buffer there. And then equity markets, right? Just, to say the least. And so, these are things that help drive consumer spending for the groups that are the real needle movers. And I would argue that really haven't slowed. And even with that in place, you've seen a deceleration in inflation.
Well, isn't that the problem with the savings rate, right? It doesn't account for stock market appreciation.
Yeah.
Right?
There's a lot of problems with it.
You get dividend income, you got interest income, but it doesn't account for, paper wealth going up or real estate values going up. And I think, that's always been the case. And I would argue it's become more and more problematic. And, I want to kind of pivot to data quality next. And we can start with the savings rate because the stock market is now more than 2 times the size of the economy. Home equity is like a factor of I want to say 6 or 7 times income or something. These multipliers are obscene. So if you're not accounting for the wealth effect, it could look like, there's a really low savings rate. And so how do you think about that? How do you tease that out?
Yeah. And so I don't look at the savings rate as, I don't focus so much on what is the level. Right.
Yeah.
I think direction of change is more important here. And so, like I said, if you look at the savings rate, year to date, right? So we bottomed at about 3.5% in December 24, so entering this year. And in April, it almost hit 5%. That direction of travel is totally consistent with the uncertainty backdrop.
Yeah.
And people becoming more worried. Yeah.
And the numbers don't even matter. You just know that it's going higher. There's uncertainty and it's pulling back.
And I don't think that was, and it's all related, right? So the stock market, obviously did poorly in that little couple week window around Liberation Day. Did that elicit more saving than would have been the case in April? Probably. But it's been kind of a trend since the start of the year. And I think the tariff noises has obviously led to this increase in precautionary savings. So I care more about the direction of travel there. You're right. If you look at, I would say, if you want to get a holistic view, you look at something like household net worth, and that's at a record.
It's obscene. Yeah, it's just crazy multiple. So I want to talk about data quality. You touched on it with respect to CPI. The most followed, forecasted, reported on data point is the employment data, the payrolls report. That data set has got a whole host of problems. The broader question is, as the data quality has clearly deteriorated due to a combination of lower survey response rates, and even most recently, I saw some of the CPI collection data has been lacking, and they've been estimating some data more so than they have been in the past, and just the data not really representing the fact that there's such bifurcation. So how do you think about all of that? Basically, how are you doing your job with all of these nuances and data and weaknesses and strengths on top of a world where now you've got AI, LLMs, machine learning, which you guys have utilized a lot in your work to do what you're doing, basically?
So, yeah, I love talking about this because I think it is a big problem. And so, right, like the CPI is a great example. We kind of went through why OER and rent are problematic, especially if you're using this as a tool to set monetary policy, right? You'd think that you'd want as up-to-date information as possible. And, the Fed's aware of the lags, and yet they still use this as one of their main tools. And I would argue that employment is in that camp as well. So you look at non-farm payrolls, and I'll answer your question first, like, how do we get around it? How do we think about it? I think it's just being aware of what the pitfalls are and trying to adjust for those pitfalls somewhat, and then leveraging alternative data as well that, in fact, might be better in today's day and age. So I look at something on the CPI side, for example, when I'm building out, my views about the direction there. We've leveraged the Adobe Digital Price Index, which is actually hundreds of millions of SKU that are being scraped, prices people are paying in real time, versus having some BLS worker go out and try to sample a bunch of products, right? We have the technology to be better, and we haven't moved past these archaic metrics that we look at to set policy in particular. So we do things like these alternative data. On payrolls, it's a great example because you have a couple of problems there, right? So one, you've got a data collection problem when it comes to the initial print, which is the one that everybody worries about, right? No one cares about the revision T-minus 2 months ago. The response rate to the survey has gone from about 75% pre-COVID to about 60% on average. We've had months in the last 6 to 9 months where you've clocked in the 40% area, like in the mid-40s, which is abysmal, right? It's also a survey, right? People have to respond to it, right? The data quality, there's sampling error that can be involved there. There's an additional bit, which is the BLS tries to make adjustments for, are we adding businesses or not to the economy, right? This birth death adjustment, which has been just dead wrong over the course of the last several years.
They should just let that thing die.
Let it die, or, come up with a timelier way to estimate it. Because right now it's just this massive, laggy, auto-regressive process. And so what we've seen is a couple of things. Payrolls get revised down almost every single month on a monthly basis, and they get revised down when the annual benchmark is done significantly. So you get the QCW data, which is the roll-up of everybody that contributes to unemployment insurance. We have almost a perfect count of that. And last year they had to revise it down 800,000-ish for the year.
just a touch.
Yeah, the data through the fourth quarter on QCW through 24 suggests another massive revision, 750 to 900K to the downside. So what are we looking at? We're kind of ignoring payrolls here. We don't ignore it because it matters for the market, right? Like the market responds to it, we have to respond to it.
Well, that's the irony, is that The market doesn't care. At the end of the day, the only real data is earnings from a market perspective.
Yeah.
And even, of course, that could be fudged. But at the end of the day, I observed, at least coming out of COVID and all the craziness and everything you just said, is that the market just takes everything at face value and then asks questions later. And you have to appreciate that as an investor, or acknowledge that as an investor. And getting too nuanced and finding these things that are just not going to be widely understood either will take a long time to become understood until they're very obvious, or just will never matter. And so that's, as a market analyst dealing with the same data you're dealing with, understanding how the masses are going to react has certainly been part of the game.
I totally agree with that. But I think what that does is also open up some opportunity if you are finding maybe alternative data that are telling you a more realistic picture of what's actually going on. Because the data that's prone to, call them statistical errors or what have you, noise, will converge to the others, right? And so right now, I'm looking at my dashboard and I'm seeing, okay, payroll growth was still okay, 120K-ish last month. The unemployment rate's, 4.2, not to worry. But I look at layoff announcements, I look at WARN data, which is these filings you have to do with the state if you're going through a mass layoff before you do the layoff. I look at small business sentiment on labor. I look at ADP employment, which actually declined, right, recently. Paychecks, the small business index, it's been negative for 6 months. These are, so ADP, I want to make, ADP and Paychecks in particular, right? These are actual payroll counts. They're not surveys, right? And so it's hard data. I mean, we call the NFP hard data, but it's still a survey at the end of the day, which then goes through all these statistical gymnastics. So I would argue that it's important to know, like you said, rightly, what the market cares about, have a view on that, but then also where that might be wrong because of measurement, lags, what have you, and then have enough information to complement that to either confirm that that's where we are, or maybe go aggressively against that view. That's, that's part of our approach, whether it comes to inflation or labor. And you just have to digest a ton of information to get there.
That's a great point. The market in aggregate is pretty good at climbing the wall of worry, but eventually the check comes due, and understanding the data is so important.
Yeah.
Data dependent world. So thank you so much, Jake, for giving us a look behind the curtain at all these numbers and understanding it. I'm definitely wiser today, and I follow this data all the time. So thank you so much. Can't wait to have you back to explain the next big data set the market's focused on.
Sounds great, guys. Thank you very much for having me.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.